welcome to That's Entertainment, the weekly entertainment show where we look at all the interesting entertainment news from last week, this week. One news story has dominated all others last week: Netflix quarterly results. We'll be looking at the coverage of the story in the trades and by various industry pundits in order to consider what implications those results might be both for Netflix and the wider streaming video sector. Netflix announced that it had lost 200,000 subscribers in Q1 this year and expects to lose 2 million more in Q2. As Variety pointed out, this marks the first time that Netflix has lost subscribers during a quarter in 10 years. The expectation it would perform poorly compared to previous quarters was a given. The fact it actually lost subscribers is quite shocking. Netflix cites both increased competition and password sharing, which the streamer is looking to monetize, as drivers of this subscriber loss. Consequently, Netflix share value saw a massive drop, with Deadline Hollywood reporting shares plummeted more than 20% in after-hours trading after the company announced that it actually lost ground. And the situation went from bad to worse, with Variety revealing that Netflix loses $54 billion in market cap after the biggest one-day stock drop ever. Shares plummeted to their lowest point since January 2018 as investors reacted to the streamer's first subscriber loss in more than a decade, bringing years of booming growth to a screeching halt. Netflix shares have shed 65% of their value over the last 6 months. The Advanced Television website reported that one leading US hedge fund manager subsequently sold $1 billion worth of stock he bought in January at a loss of almost $400 million. Bill Ackman told his investors in an explanatory note, "We have lost confidence in our ability to predict Netflix's future prospects." Netflix themselves gave 4 reasons for their declining fortunes. 1, increasingly clear that the pace of growth in our underlying addressable market is partly dependent on factors we don't directly control, like the uptake of connected TVs, since the majority of our viewing is on TVs, and the adoption of on-demand entertainment and data costs. In addition to our 222 million paying households, we estimate Netflix is being shared with over 100 million households globally. And over the last 3 years, as traditional entertainment companies realize streaming is the future, many new streaming services have also launched. Macro factors including sluggish economic growth, increasing inflation, geopolitical events such as Russia's invasion of Ukraine, and some continued disruption from COVID are likely an impact as well. The issue of illicitly shared passwords is something that Netflix has already flagged in recent months, highlighting that over 30 million of those viewers are located in the US and Canada. MoffettNathanson's principal analyst, Michael Nathanson, observed that the number of password-sharing users in North America is further evidence that the product has hit maturity in key markets, while Netflix themselves acknowledged that account sharing as a percentage of our paying membership hasn't changed much over the years, but coupled with the slowing pace of broadband and connected TV adoption means it's harder to grow members in many markets, an issue that is obscured by our COVID growth. Deadline Hollywood reported that Netflix are eager not to lose those viewers, but to turn them into paying customers. Executives said that Netflix started some light test launches over a year ago and just concluded a first big country test. A solution will take a while to work out, likely requiring a year of iterating and deploying it globally, including in the US, said COO Greg Peters. The idea, he suggested, isn't to wipe out password sharing, but to charge people to do it. In the process, the company will be focusing more on revenue and subscriber accounts versus a fixation on individual subscriber numbers. Well, it was pretty obvious that the pandemic was going to lower the tide in terms of the amount of time people had to watch all these different streaming services. So, as horrific as these streaming wars are, I think Netflix is probably best positioned out of all the streaming platforms to weather the next few months. I think there's definitely some rethinking that needs to be going on here. Remember in a recent episode, we were talking about how Netflix was changing its internal monitoring systems away from growth in audience numbers into the growth of audience time spent on the platform. Obviously, this new KPI is one of the things that they're going to be looking at to measure success going forwards, and that's probably what they're going to be starting to tell the market more and more about over the next few years. The streaming giant also identified other areas where it could potentially claw back some of that lost revenue. The Hollywood Reporter stated that the streamer will be pulling back some of its content spending over the next 2 years to increase its revenue goals. And according to CFO Spencer Newman, we're pulling back on some of the spend growth across both content and non-content spend. We're trying to be smart about it and prudent in terms of pulling back on some of that spend growth to reflect the realities of the revenue growth of the business. But not everyone agrees with the strategy. Forbes' Paul Tassi reckons that Netflix is losing subscribers because its competition is cheaper with better shows. Like a frog boiling in water, Netflix has been constantly increasing its prices over the years to the point where its US premium subscription, which offers over 4 screens of play, a must for many families, and 4K content, is at $20 a month. That's higher than any of its rivals by a significant margin. Other streamers are doing more with less. Disney Plus has a pretty severe lack of adult content, and yet they are dominating cultural conversations year-round with whatever Marvel or Star Wars show is airing. Whereas Netflix can throw $100 million at a season of The Witcher, and because of its binging release, no one is talking about it the following Tuesday. Look, no one will dispute that Netflix doesn't have more content than all of its rivals. They all say that's what you're paying for with the higher price, and yet, if you're looking for culturally relevant and critic audience beloved series, Netflix often seems to have the worst offerings than its rivals. Lightshed Partners analysts Rich Greenfield, Brandon Ross, and Mark Kelly agreed, writing in a note, "The single biggest issue that really was not talked about is that Netflix's content, especially in English language content, is simply not resonating relative to the level of spend. With Netflix spending more than anyone else in the industry at $17 billion annually, including $5 billion on movies, Netflix should be creating significantly more must-see TV series and movies that become ongoing franchises." Remind us of one of former HBO bosses, Richard Plepper's favorite lines: "More is not better, only better is better." Next, TV's David Bloom went further, highlighting another crucial lacking in Netflix's content offering today. Lots of observers say Netflix needs more big-name shows, especially because it doesn't have a decades-old library to back up its new programming. The importance of a wide breadth of catalog content has been proven again and again, with the number of streaming viewing hours often given a massive boost when users turn to old and familiar TV shows and franchises, with dozens, if not hundreds of episodes on offer. Recent years have seen Netflix lose much of its archive of evergreen content, with studios like Disney and Warner, Universal and Paramount eager to host it on their own streaming platforms.